All right, everybody, Stocks by the Numbers, welcome back. Wanted to do just a quick update looking at a brand name company in the space, tech stock that's obviously been around for a while. I'm sure you guys have heard of, but is this potentially an excellent price to get in? Should we maybe wait and remain patient if we wanted to take a position in the stock? So let's get into it. Name of the company we're looking at today is Oracle Corporation, ticker symbol ORCL, listed here on the New York Stock Exchange. Stock right now, just a couple of cents over $115 a share. It's up about half a point, about 0.4% here on the day. The stock recently reported earnings back here about the first half of March, and we can see that the company beats on the EPS side, but misses by about 6.5 million on the revenue side. You can see, obviously not that big of a miss. And basically what's going on is the company consistently mentions that they're expanding. Again, you can see adds AI to database software in broader pitch for its cloud platform. The revenue has been growing nicely, and apparently the demand is there. So if we look just at the earnings, again, we can see we have a beat, top and bottom line. Then we have a miss on the revenue side. Next quarter, beat on EPS, another slight miss on the revenue side. Next quarter, another EPS beat and a slight miss on the revenue side. So technically, of course, you could make the argument, why is this stock up when it's, technically missing earnings? But again, it is the forecasted growth and the future demand that they consistently keep mentioning, which is why, in my opinion, analysts, investors, and, Wall Street big boys alike all basically see value here, in my opinion. So if we look at the numbers again, we could potentially make the argument we can begin to sell off here. Again, it was kind of in the symmetrical triangle, it looked like, in my opinion. Then these earnings came out and it popped up, broke above the range, hit new highs of almost $133, then kind of started to sell down here into this potential descending wedge. Had a recent pop not too long ago and tried to get back up to that 20-day moving average, and you can see it basically got right up to that average and then kind of rejected, started to step down. It tried to reclaim this trend line here, but we can see today the stock kind of seems not necessarily weak, but as of right now trading below this trend line. So in my opinion, we can potentially retest this fib and maybe form a double bottom and get some momentum, or we can potentially come down, break the fib, meet up with this top trend line now, and we can potentially break down to maybe about 108.5 here. You can see that this was kind of like the top it rose up to, it paused, got momentum coming into these earnings, and then boom, popped after the report. So in my opinion, we can potentially save ourselves a couple of bucks here if we did want a quote unquote ideal price and time. But overall, basically seems to be growing over time, and of course they pay a dividend to own it. So this is what I mean when I talk about long-term investing, and of course dripping the dividends. DRIP stands for dividend reinvestment program. So a situation like this, you invest about 10 years ago down at $30 a share. Overall, your principal is up several hundred percentage points, and of course if you dripped over those entire 9 or 10 years, you're probably sitting on a significant chunk of change right now. So this is why, again, I say that if you plan to be around in several years and you're still probably going to be working and looking after your investments and trying to grow the money you have now for 7-10 years from now, then in my opinion, taking some positions in a stock like an Oracle or something like a Philip Morris that is going to maintain its value, slowly grow over time, consistently increase and pay out dividends to you, in my opinion, it helps to work smarter, not harder sometimes. But again, obviously, whatever strategy you use, it's your money, it's entirely your own prerogative. But looking at Oracle here, we can see we have a market cap 316 billion. Companies paying out a dividend right now, yielding about 1.4%. We have a PE of a little over 30 times earnings. And our beta, again, the beta is the volatility of the stock in relation to the overall volatility of the market. And we can see the stock trades a little bit over 1 times as volatile as the market itself. But the EPS side has been solid over the last several quarters here. We have 4 beats in a row, expecting a slight bump up in EPS next quarter to $1.65 a share. Last quarter, they posted $1.41. But again, it is basically the demand and the future growth that everyone is looking at, which is why, in my opinion, even them slightly missing, and again, it's very, very slight misses. You can see this was technically the biggest percentage miss, and it was only 0.8%, right? And before that was less than 2/10, and as of last quarter was almost basically in line. So this is why if the company missed by, 5-7% on revenue, then we can potentially be talking about a different story. But even with the estimates being chunked up here back up into the 13 billion plus mark, the company's still able to basically report in line. So in my opinion, I don't think that Wall Street's viewing that as a big negative. But again, in the technicals, we can potentially come back down to the fib here, sub 113, and maybe even potentially come back to this recent zone here before we took that next leg higher of about like 108.40, 108 and a half. But overall, even a 30 PE for the space they're in isn't that overvalued, because we know tech stocks usually trade at higher multiples than other sectors. But we can see we have, the big jump in Q4 basically seems to be their biggest quarter, and the revenue has been slowly stepping up throughout all 3 quarters of 2023 that we have so far. Net margin dropping down a little bit, you can see into the low 19s as of last quarter, just about 18%. But overall, in my opinion, a lot of the fundamentals do look good. And if we look at what they reported, we have about 12.5 billion, almost 13 billion, about 13.25 billion, right? So if we do roughly 13 billion times 3, we're at what, like 39 billion. And now they're estimating over 14.5 billion, which of course would bring annual revenue, if this gets reported, would bring annual revenue to above 53 billion, which as you see would be year-over-year rise right there of about 4 billion in change. So the company basically consistently continues to be a player in the space and continues to grow. So, growing the stock price over time, in my eyes, basically makes sense, of course. But let's switch over here to the fundamentals real quick. And we can see that on the annual side, the company has been doing very well on these revenue estimates, and of course, as of late, a couple of misses. And on the EPS side as well, not only beating for the last 4 quarters, but beating for the last couple of years as well. Dividend consistently, gets increased, as you see, 81, 96 cents, $1.04, $1.28, $1.36. And the debt has risen over the years, getting up to 95 plus billion, but we can see that closing out 2022, the debt was about 95.25 billion, and since then slowly began to start pulling back a little bit, touch below 89 billion, 88.79, slight dip, and then down about a billion quarter over quarter to sub 88 billion. So that seems to be heading in the right direction. The cash does kind of bounce around, but as of last quarter, sitting on about 9.5 billion. We have positive free cash flow. Short-term liabilities are outweighing short-term assets, and it does seem close. And the equity is not that drastic when compared to the current market cap of the stock, which is why I'm saying again, if markets really do begin to chunk down, if something like an Oracle drops from 115, let's just say, down to like 96 or something, in my opinion it would actually be justified, because it would kind of be bringing it back down to earth. But again, the long-term growth and value here, in my opinion, really cannot be denied. And we can see that assets have increased basically over the last 7 or 8 quarters for the most part, and we can see that liabilities were up here in the mid 130 billions, coming down to the low 130s, breaking below it, and then slightly getting back above it. So it does seem to be slightly seesawing for the last couple of quarters, but overall here, you can see the trajectory here of liabilities slowly ticking down while the assets slowly ticking up. And you can see this stock actually had negative equity here north of 5 billion just about 7 quarters ago. And then you can see tail end of 22, we turned to positive equity, and then we just continue to step up here. Again, total assets minus total liabilities yields total equity. And we can see about 1.5 billion, 2.8 billion, 4.33 billion, now up to almost 6.2 billion. So again, technically still a long ways away from the actual market cap of the company to make that kind of comparison with equity to market cap. But overall, it does seem that the stock is moving in the right direction with a lot of these metrics. And we saw the debt coming down a little bit. Book value, again, we can see was negative. Now it's positive. Was negative 218. Now it's positive 205. But that's a pretty big price to book ratio that the stock is trading in. But in my opinion, a lot of the other fundamentals seem pretty solid. So we can see that, again, Q4 is their best quarter, but overall you can see quarter over quarter looking year over year from Q1 22, Q1 23, Q2 22 to Q2 23. We can see consistent increases year over year for the quarters, right, in the previous year. Cost of goods sold basically seems to be in line, right? We got up above this 4.5 billion mark, dipped down below it, got back above it, and then, as of last quarter, 4.62 billion. Total revenue minus cost of goods sold yields gross profit, and we can see the gross profit for the most part consistently stepping up and up. Used to do 7.5 billion in gross profit, now we're up to 8.66 billion gross profit. Operating expenses, again, basically remaining in line. They were consistently climbing for the most part up to almost 5 billion. Then we came back down, and we've just kind of been hanging out in the range of this minus 4.6 billion and change mark. And we can see that as the gross profit has been increasing, but the operating expenses have kind of maintained flatness. Gross profit minus operating expenses yields operating income. And we can see the operating income, for the most part, also has been slowly stepping up, now getting back up to that 4 billion mark. So overall, in my opinion, again, could make the argument that, of course, if we sell off big, this stock can, of course, start losing value. But overall, it does seem to be maintaining that high grower status, if you will. But PE, we can see mid to high 20s, even getting to the mid 30s here, almost 36%. So PE here at about 30 and a quarter, basically in line, along that mean average going back the last 7 or 8 quarters. Same thing with the price to sales. We were down here sub 5 for a little bit, and then we got up to the high 6s, slowly pulled back to 6 even. Now we're at 6.15, so that's basically middle of the range as well. Price to cash flow, same thing, as low as 15 for a little bit, getting up to 17, up to over 19 and a quarter here, and now we're sitting at 17.7, basically middle of the range. Price to book we looked at, trading over 50 times book, but you can see how it's slowly coming back to reality here with this ratio. Reason being is because, again, the price to the book value itself seems to be consistently increasing quarter over quarter, right? So this ratio is going to come more and more in line. The enterprise value, again, supposedly is what another company would pay for this stock. And you can see enterprise value almost 394 billion. Not exactly the main metric you can use, but, could make the argument that if you use it, the stock could be viewed as undervalued. Return on assets, climbing. Return on invested capital, also, we can see got up to 12.5 and then dropped down to the lower double digits here, sub 12, and now we're back up to about 12.3. So we are kind of at the higher end of the range, but you want the return on invested capital to consistently grow for the most part. But look at the gross margin percentage, right? This is what I talk about when I personally speak about finding solid, stable stocks that are maintaining these metrics, maintaining these margin percentages, but consistently able to increase their business, increase their footprint, the market share, and slowly but surely gain more and more revenue, which will in turn hopefully lead to wider and wider profit margins. But you can see, look at the gross margin percentage here. 65, 65, 65, up to almost 67, slightly sub 65, back up to 65 and a quarter, back at 65 and a quarter. It really doesn't get more stable than that. So the company has basically been maintaining a gross margin percentage of about 65 and change for about the last 8 quarters. So this is what I mean when I preach about stability. But again, this is just my opinion. Whatever you do with this information is entirely your own prerogative. Operating margin down here in the mid-20s, high 20s, gets above 30, comes back to the high 20s. Now we're back above 30. So technically that's at the higher end of the mean average range going back the last 7 or 8 quarters. It's a good sign, in my opinion. EBITDA, again, earnings before interest, taxes, depreciation, amortization. We can see high 30s, gets up to almost 40, above 40, maintains high 30s, back above 40, and now as of last quarter, 41.8. Again, second highest. This is Q4 of 22. Second highest since Q4 of 22, but for the most part, above the average of where it came from of the high 30s. Net margin percentage, we can see we were steadily climbing, got up to almost 24% and have been consistently dropping. However, even coming down to this about 18% mark, you can see it's several percentage points higher than where the company was, a year and a half prior. So that's why even when these margins do slowly step down sometimes quarter over quarter, regardless if capital expenditures increased over the quarter or whatever the case might be, at the end of the day, if you're still technically in a better spot than you were a year and a half, 2 years ago, then technically you would view that as a positive. But we can see the asset turnover slowly climbed up to above 0.4, kind of maintaining at that 0.39. We looked at the debt slightly starting to come down, so our debt ratios now kind of lowering a little bit, coming in line. Stock consistently pays a dividend over time. And if we look at earnings, we can see the EPS side has been pretty stable with only one miss over the last 8 quarters. Looking on the annual side, we can see the company has not missed on the EPS estimate since 2015, which is pretty impressive. The revenue side, again, as of late, coming in a little bit light, but again, very, very slight misses here. Look at this, 0.25%, less than 0.2%. This is the highest miss here of 0.8%. And then they bounce right back the next quarter with estimates jumping up to north of 13.25 billion, and the company posts almost in line and misses by 0.05%. But now looking forward, we can see Q4 again, usually their best quarter, and you can see revenue estimates 14.6 billion. That same time the year before, 13.7. That same time the year before, 11.6. So this company, the growth really cannot be denied here. So again, that's why even though the company technically coming in a little bit light, it seems like the demand and the growth is going to be there. And even looking forward into 24, we can see Q1 13.4. Q1 of this year, less than 12.5, right? So we're growing basically at almost like roughly $1 billion in change year over year, right? Looking at the quarter comparisons. So definitely nothing to sneeze at in my opinion. But if we switch over here annually, more importantly, the longer term, broader picture is that this company, for the most part, rolls on all cylinders over the years, right? And we can see slow, steady, stable growth in the revenue over the years, going all the way back to 2015. The stock has not missed on an annual revenue estimate. And we can see, again, we added up the numbers quickly before. We have 14.6 coming in. So if they're able to, again, basically come in line or a very, very slight miss below that, chances are they have a good chance, in my opinion, to come in above that 53.25 billion mark. But more importantly than that, looking further out, we can see the growth expected to be maintained. 24 up to 57.8 billion, 2025 almost 64 billion, 2026 almost 69 billion. So this is what I mean. This company looks to be maintaining its value and continuing to grow its business. Looking at all segments here, we can see we're growing here in the service segment, and of course the cloud segment has been growing nicely here, up almost 30% just in the last couple of years, growing across basically all markets, or geographies, I should say. Slight drop there in the UK, but again, these are 22 numbers. But we see that the bread and butter market for a stock like Oracle is, of course, the United States, and that market continues to remain strong. So, yeah, in my opinion, if you told me you like this one, even up here at 115, and if it dips to, 103, you don't even care, and you're just going to buy more and continue to accumulate. In my opinion, obviously, I really wouldn't fight you tooth and nail on that situation, but just wanted to look at some possible pullback levels. But overall, I have to say I do like the stock. It really has grown nicely over the years. We have over 30 analysts currently giving their personal opinions on this stock, and we can see 16 are giving it a strong buy, 3 are giving it a buy, and 15 are giving it a hold. So across the board, these analysts are basically in agreement that this is a stock that you should either continue to hold or continue to buy. We do not have one analyst giving it a sell or a strong sell. And again, reason being is because, in my opinion, even though slightly light recently, overall, this really seems like a stock that would be very, very hard to bet against, right? And that's why I'm saying, if we hypothetically topped out these markets and now we begin like a 3-month sell-off or something like that, yeah, Oracle, of course, has the ability to sell off and come down to low hundreds, sub 100 a share. But if we're talking overall long-term, as you can see, the analysts basically on the same side of the fence. And if you plucked one out of the crowd and said, where's Oracle going to be in 18 months and 24 months? As you can see, practically all of them would say it is going to be higher, and I think it's a buy. So lowest price target you can see down here at 105, and again, that's kind of basically right around fair value in my opinion. Like I said, even if we pull back and retest my personal trend line, we're looking at like 108, right? So only a couple of points away from that 105, and then chances are, even with the 105 price target, that analyst probably has a buy or a hold rating on it, as we saw. So if it did pull back to 105, that analyst would probably say, I think it's a buy now. It pulled back, it's a more fair price, and I would get in there and ride the wave back up. So Oracle, basically decent across the board. And in my opinion, I do like the way a lot of those metrics are moving or maintaining. Again, like we looked at the gross margin percentage, essentially 65% across the board for the most part. I mean, it really doesn't get more stable than that. But we can see, looking at some pivot points here, the stock, like I said, tried to retest that 20-day moving average on the previous chart, and you can see it basically came up to the 50-day moving average here on the daily, and then we had the rejection here. Recent pivot point 118.04, couldn't hold it, but we can see also that just about like a week ago, the stock came down and hit that apex of this potential wedge that we saw and bounced right off of this previous support level, and of course, more importantly, the 200-day moving average popped up and got above it. So in my opinion right now, I'd probably say the 200-day moving average would be the spot to watch, because we just retested and had a bounce, right? So we have to see if we want to come down and retest and potentially break and drop to sub 110, or if we're going to bounce up again and, try to reclaim that next pivot point back into the high 1 supposedly. But we can see the MACD obviously pulling back with the stock, and now we've kind of flattened out, it looks like, so we could potentially be making the recovery now moving forward, which is why I'm saying, again, they may want to potentially bring it down to retest that moving average, but got to keep an eye on it, because it can potentially form that double bottom, which could form the reversal and obviously bring some momentum back into the stock. The RSI, basically lower end of the range, but it's sitting here, we'll call it about 41.5, but we recently got above that 70 benchmark after the earnings came out, and we heard news of that increased demand and that consistent demand, and then again started to sell off. I'm sure a lot of people may have taken profits in the shorter term if they played it strictly for earnings. I mean, the stock popped and hit new 52-week highs, so we can't exactly hold it against them, right? But let's switch over to the Bollinger Bands real quick. And we can see, yeah, so mid-Bollinger Band about that 118 mark as well. But yeah, in my opinion, it looks like that this 200-day is the one you're going to have to keep an eye on, in my opinion. And if we break, like I said, maybe we can test those low 100 levels eventually if we do break. But of course, it is much easier to react than it is to predict. But on the weekly, we can see, even when we do have these big sell-offs here, going back to October of last year, that's when the markets had that 3-month sell-off. You can see they brought it down basically to the bottom of the range. It almost got to that 50-day moving average on the weekly, and then it had a really nice strong bounce and reclaimed that mid-Bollinger Band. And then what happened? It dropped back to the 50-day moving average, right? They hung it out for a little bit. They had the quick flash crash, and then you had the immediate rebound, bouncing off the moving average and getting back above and staying above that mid-Bollinger Band, coming back down to sub 50-day moving average to retest it, and again bouncing right back to the mid-Bollinger Band, and then boom, having that big pop. And now we're coming down and we're kind of seeing the same thing. Recently tested that 50-day moving average on the weekly, and the stock had a little bit of a bounce back. So you have to go all the way back to October of 22. That was the last time the stock was below the 50-day moving average. And you can see, even throughout most of 21, the stock was well above the 50-day on the weekly. 22, basically a rough year for the stock in this downward consolidating channel below the 50-day. And then boom, had that big explosion end of 22, throughout 23, and even continuing to grow here in 24. So overall, in my opinion, I do like it. On the weekly, we did technically recently cross to the downside, which is why I'm saying we may potentially come back down to that 200-day moving average on the daily and potentially try to see if we can bounce it again. So we'll have to keep an eye on a couple of those levels I mentioned. Right now, it's kind of in limbo, kind of in between some of these points. RSI on the weekly, middle of the road, basically sitting here a touch over 50.5. But yeah, that MACD and that daily moving average, a couple of those price targets we mentioned, in my opinion, those are the ones to keep an eye on in the immediate short term. But overall, Oracle Corporation, ORCL, again, this is a name that has been around for a while and has been growing very, very nicely. And if we pull up an all chart, I mean, look at this. Obviously, on the up and up here throughout the 90s. But as soon as we come out of that big .com bubble in the 2000s, again, we had the big drop down here on practically all stocks, not just tech stocks. But then you can see Oracle just on the up and up, just steadily climbing inside of this tight channel, and even recently popping to the top mid end of the range, really, of this big channel. But you can see for the most part here, look at that, just look at that, coming down to that low and then just staying consistently climbing up and up and up and up inside of that channel. So this is why I say, again, everyone wants to talk about the trading. And listen, I mean, I love to trade. We all love action. We all love to make big money, and we love to make quick money, right? That's why trading is so awesome. But this is why I say, again, at the same time, if you're building up an account, thousands, tens of thousands, hundreds of thousands, right? And again, obviously you guys, if you've gotten to the 7-8 figure mark, chances are you can attest to what I'm saying, and you can back me up in the comments if you'd like. But chances are, if you're building up an account, I got 20 grand, I got 50,000, 200,000, in my opinion, no one is saying you can't do options, have some fun, take some action, try to make some quick profits. But overall, the bulk of your account should be invested into more conservative, steady growers. And it doesn't necessarily have to be a Philip Morris or an Oracle, right? It could be an index fund. It could be a bond fund that pays you out a good yield, right? That you can consistently reinvest in. And it always turns out that, again, like I mentioned, they did the study, they looked at the millionaires in this country who were made from the stock market, and practically all of them achieved that 7-figure milestone breakpoint because they had a company like this. They had 1, 2, 4 positions of stocks like this that they consistently added to. They consistently redripped and reinvested those dividends for compound investing over 5, 10, 20-year period. And now, at the end of the rainbow, they now have their pot of gold. And, the initial investment of whatever, 20, 30, 40,000 is now worth several hundreds of thousands of dollars. And in my opinion, that's what you should be aiming for, right? So if you turn around, 5 years from now, and you're essentially at like the same liquid net worth, I mean, then technically you did something wrong, right? Because again, we all like to chase those 500%, 8,000% movers. And again, if you get them, congratulations. But if you don't, in my eyes, you're basically making your job just that much harder. So why not eliminate some of the stress and start to move the bulk of your capital into positions, whether they're stocks, whether they're funds. Why not move a lot of that capital into positions that will consistently be growing and working for you, where you don't have to hope and pray and stress on the situation that it does well for you? But that's pretty much it. I said my spiel, and I'm going to end it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky, they're volatile, they are very uncertain. So I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. Have a good day, guys.